Hello, LadaRay and moderator Oz here. Together with nearly 100 participants, we had a fantastic first live LadaRayWebinar. Will Trump survive his first term? The webinar discussion included why Trump made so many decisive moves so early in the term, the risk of his assassination or impeachment, how Trump is put in his political straitjacket, Trump's importance for the Earth shift and upcoming European shift, will Merkel be re-elected in Germany, and French election prediction. Can Putin and Trump work together in Ukraine and the Middle East? Russia, China, USA triangle and the secret Kissinger plan. LadaWay predictions. Will anti-Russian sanctions be taken off? What can Trump offer Russia? What is Putin's strategy? Part 2. Lada's prediction on whether Trump will survive his first term. Real reason Melania Trump won't move into the White House and quantum calibrations. Later, we had an extensive Q&A during which Lada answered a number of questions, including Trump, Earth shift, the environment, light workers, free energy, Russia, Japan, Israel. Will Trump authorize 9/11 and alien disclosure? Was there a secret alien and German Nazi base in Antarctica? And reinventing collapse by Dmitry Orlov. Full webinar descriptions can be found on the webinars page at LadaRay.com. Although the Q&A lasted 1.5 hours, we were unable to cover all participant questions. We are offering you a new series of free Ask Lada videos in which we'll answer the most interesting and popular webinar questions. Without further ado. Hello, Lada.
Hello, Oz.
Okay, we're going to go on to the third question, and Anne asks, in the run-up to the election, Trump said a couple of times that there will be a market crash before the end of the year. So why then did the market, against all expectations, hit all-time highs? Well, I'll take this question, and since I have a little bit of background in finance, this is the real reason why it went up. There's an old adage on Wall Street, buy the rumor, sell the news. Initially, stocks run up prior to elections because the results of huge speculative bets placed on the stock indices, which lift the overall Dow, S&P, and NASDAQ individual stocks. So when it sells off after the winner is declared because of profit taking, however, this time around, Trump announced several major deals he made with U.S. manufacturers to retain jobs in the U.S. in order to fulfill his campaign promise. Most notably, Carrier Corp and several major car manufacturers recommitment to Detroit. This is seen as good for business, so the market rallied off this bullish news. Now all those who shorted the market anticipating a fall had to cover their shorts. This is called a short covering relief rally and may last for several months as the shorts take time to unwind and need to buy back stocks at even higher prices to cover their losses. This causes a short-term rally as momentum builds, attracting new buyers from the sidelines. And incidentally, this is what happened to one of the major players, financier George Soros, who reportedly lost $1 billion betting against the Trump election. His short selling is what triggered this latest rally, which could continue for a while until all buyers are exhausted with no fresh news to sustain it. So do you have anything to add, Lada?
Yes, certainly. Okay, so here's what needs to be understood. That's a great background that Oz gave you. Oz actually is also one of the former Wall Street traders. He actually did that. That was his daily job, so he knows what he's talking about. And as you know, I worked as a financial consultant for Smith Barney, had a lot of private clients, including international clients, which was my biggest base. And I also dealt with a lot of this stuff. We also, of course, had our own connections, and we can draw on those connections and what we learned from, even if we did not deal with, say, derivatives directly. Like a friend of mine was a PhD from Moscow University, who was at the forefront and was at the beginning of the derivatives development in the early 1990s on Wall Street. She worked for Salomon Brothers. Then when Salomon and Smith Barney merged, she became part of the Salomon Smith Barney brand, and she headed the department, the derivatives department. So she was actually at the forefront and at the very beginnings of the derivative development, which at the time, the new style derivative development, because there were derivatives before that were necessary for certain, like futures and stuff, but those are simple derivatives. Now, they employed these high-level mathematicians and programmers, in the 90s on Wall Street to develop this new generation of derivatives. And now we have this runaway quadrillion dollar worth, many quadrillion, I believe, dollars worth of derivative market that is, dragging down the entire economy. This is the reason many people wonder, they bet on gold and silver and other precious metals to rally because of the conditions of the markets and the predictions of various gurus, and this never happened. So gold, silver markets and platinum, palladium never actually rallied. They actually stayed down. They even went down below those levels at which they were in the beginning of the first rally in mid 2000s. And the reason for that is the derivatives. So whatever movements in the market you are seeing, whether it is precious metals market, oil market, all kinds of natural resource market, which is called commodities, incidentally, on Wall Street. So any commodities from agricultural, wheat, orange juice, various other like coffee beans, or into metals and into energy resources, etc. All this is called commodities, and into the stocks, value of the stocks and such. So derivatives is what skews the market one way or the other the most. Short covering is what Oz described for the position, like somebody actually bets that market goes down as a result of a certain event. In this case, Soros and his cronies, as well as other players in the market, they bet that the market would react in a certain way. They bet initially on the win by Hillary. Then after that, there had to be a very quick reversal to bet against Trump. And we discussed it in the webinar very extensively. I laid out the entire picture for you in the webinar, how Trump preempted certain negative developments right from the get-go by developing this flurry of activity in his office. In the first 10 days, he already made major announcements that some presidents don't manage to make during even the entire first year of their presidency. You know, we usually say, well, what happened during the first 100 days of such and such president. In this case, we can already talk a lot about what happened in the first 10 days of Trump presidency. He signed a TPP exit deal. He is already preparing deals with Russia. He had the flurry of activity talking to various heads of state. The long anticipated conversation with Putin. He is preparing, he's preparing a trade war with China, with Iran. He's preparing certain actions against Iran and sanctions and such, and many, many other things. You all are following the news, I'm sure, so you know as well as I do what's happening. So go refer back to the news and the Trump activities. So all this is done, including signing and promising certain changes in the production and manufacturing, moving all these jobs back to the US. This promise actually does rally the markets. Although I am sure that was a bifurcated reaction. Some would perceive it as a rally to the market, and others would perceive it as a negative for the markets, because the established system in the global markets is being challenged. So some might perceive it as a negative. So Soros and his side, that's neoliberal globalist side of Wall Street, which is probably the majority, in fact, they actually ran against Trump. And then short covering. But also now important to understand the derivative situation. Whatever derivatives actually, it's like geometric progression. They exponentially increase a certain exposure. So if, for example, you simply bet on the market, on, say, where oil will be moving up or down, or gold will be moving up or down, that's one thing. But if you issue a derivative, that actually multiplies your exposure one way or the other, both positive and negative. And so we actually receive these exaggerated moves in the market, which are very confusing and do not reflect the real state of the economy, the real state of the mood of the population and of the market, as well as it does not reflect the real wealth of the country. And attention, this is very important to understand. Why? Because derivatives, they're packaged products. They're geometric progression style products. I hope I'm explaining it well enough. And, listen now to those who are specialists in derivatives. They will explain more for you how derivatives actually work, how they direct market in a certain direction in exaggerated moves, and how they're unwound. Okay, what it takes to unwind them. Some predict the complete collapse of the US and global economy as a result of the unwinding of derivatives. I disagree with that, incidentally, but that's a very, very long conversation for another time. There will be certain elements of collapse, and they will mostly touch the US, possibly UK, to much lesser degree, because those economies do not run on derivatives. Russian economy will not be touched, actually will really, really benefit from the unwinding in the future of derivatives and the explosion of the derivative market. Real estate market will eventually benefit, but initially there will be confusion, but eventually it will benefit. Say Chinese market will not be touched that much, although it is actually Chinese market has become very convoluted. It's not clear what's happening there. There are probably too many secret deals, and unfortunately Chinese government is very non-transparent, and they're hiding a lot of the real situation. They learned from the West. They learned from the best, so they really are issuing falsified reports. The growth in China may not be as high as the reports that they're issuing to be. And what I wanted to emphasize to finish this answer is derivatives, how they affect. Are they really going to change completely the situation in financial markets and in people's wealth and welfare? Yes, they would, either directly or indirectly, but the vast majority of derivatives are concentrated in the West, and especially in the US, primarily in the US, also UK being very, very close to that, because UK is one of the financial capitals of the world. The further away from the West you move, the less of the derivative exposure you have. And so this is a very important thought that I want to leave you with. It goes beyond the question, but this is what's really important to understand. Wealth of many people in the West, especially in the US, possibly Canada and UK and Australia, is tied either directly or indirectly to that humongous, overblown, out of proportion derivative market, whether it's real estate or it's any sort of commodities or it's the stock market. Oftentimes, if people are involved in bond purchasing, in holding municipal bonds that they perceive more or less safe, or even money market for that matter, if you have your assets in any of these categories, you may not know what the managers of your portfolio put into that portfolio. This is a present and clear danger for everybody. So be very careful investing right now. It's best to deal with areas where you understand everything. Invest in those areas where you really, really understand what you're doing, not just rely on some manager. Or it's best to have tangible assets in your hand. But we saw with gold and silver how unfortunately those people who bet on real wealth in their hands, that they lost in the past several years because the market actually went down instead of up. And that's also because of derivative manipulation. So what we're expecting going forward is that derivatives eventually will crash. They will have to be, as correctly pointed out, wound down, because you have to unravel them. You have to unravel those derivatives. That's one of the expressions we use on Wall Street to describe how derivatives have to be handled when they actually have to be, you have to unravel that Gordian knot or cut it. Okay, if you decide to cut that Gordian knot because you cannot unravel it, that causes a massive Armageddon-like scenario. Okay, if you try to unravel it slowly, as some are trying to do right now, so far they are not very successful, but we'll see how it goes. To manufacture this soft landing that many are talking about, you have to very slowly and secretly even extricate yourself out of these positions and all the derivatives that have been piled up one on top of another, yet another and another. And this is the point I wanted to make. The real wealth in the hands of any individual or any country, as we judge it today, including the GDP, is false. The picture is very false. The countries that have most derivatives that are part of their economy, and we don't even know there are derivatives there, like real estate, for example, has been repackaged and repackaged and repackaged over and over again under different guises, where derivatives are included as a matter of course. Same goes for gold and silver markets. Same goes for oil. That's why oil at some point exaggeratedly tanked. Okay. And at some, previously, before that, several years ago, it went shot up too much. These exaggerated moves, which are not congruent with the real supply and demand at any given moment, they happen because of derivatives and because somebody is trying to push the market in one direction or another. We know the name of the point man of these pushes, that's Soros, but there are plenty of others who are not as big as him. There are Rothschilds, Rockefellers that their companies, their shadow interests that push the markets one way or the other. And so what will happen when we finally are forced to deal with clearing out this humongous, overwhelming cache of derivatives, which is fake money, fake wealth that does not exist, that has been multiplied on paper over and over, but it does not exist in reality. We'll be ready for this. That's my major prediction for the US. US will suddenly lose a lot of wealth. All other countries that rely on this fake wealth that they're promoting as part of their bigger GDP, they also will lose a lot of wealth. That includes Japan, incidentally, UK. In part, it includes Germany, but Germany is a lot more conservative. So is France and other European countries. They're a lot more conservative. Certainly, some industries like oil industry, gold industry, silver industry, all these, some other commodities industry, some stocks, individual stocks, and stock market as a whole, as well as bond markets. All this, when we are forced to deal with derivatives, and when petrodollar has to go down, just has no other way to go but down, all these chickens will come to roost simultaneously. So the entire West, but especially Anglo-American world, as well as Japan, I am unaware of how far derivatives have gone in China, because, as I said, Chinese have issued a lot of falsified reports about their true state of their economy and GDP. But I also believe that China is one of the countries, the upcoming multipolar world, it is one of the countries that will be a regional leader, undisputed regional leader. So they will have to deal with it somehow, and they will be okay. They will generally be okay. So I'm just issuing this warning. This is preliminary warning because we'll be talking about it some more in the future. And of course, listen to my webinars, participate in live webinars that are upcoming this year and next, and read Futures Trendcast, listen to my present and future and past reports here on LadaRay channel, and there will be more information as we go along, and I will give you more of my predictions.